Okay, we now move to the CAPM, and the CAPM is an intuitive extension of portfolio diversification model of Markowitz's efficient frontier. In the model, a risk-averse investor choose an asset at time t minus 1 that will generate an observable return at t. The investor only cares about the mean and variance of return, and hence the use of term mean variance per efficient portfolio came into being. The investor will select the portfolio that maximizes the expected return for a given risk level and minimizes the risk return for a given risk level. Sharpe ratio and Littner incorporated two additional assumptions into Marconi's framework to identify a portfolio that is mean variance efficient. The first additional assumption is that all investors agree that asset returns are normally distributed, and second, that all investors can borrow and lend unlimited amounts. So neither of these assumptions are very realistic. If we don't consider the risk-free assets, leaving only the universe of risky assets, then the condition traces out a curve which is a kind of smooth or efficient set, which will be a curve like an inverted C. It is important to recognize that the appropriate risk measure in is the standard deviation, and the portfolio that are on these curves, which are on the downside, are actually inefficient because we are not going to select them. The previous part here, all investors share the same view about joint distribution, and the set of efficient is agreed upon all investors. But the above analysis does not provide guidance on which portfolio is best, because the northeastern will provide greatest return but will be accompanied by more risk. The risky asset by definition will generate guaranteed return of RF and with zero volatility. That was the risk-free. So risk-free is investable option for an investor, and the set of efficient portfolio should include a point on the y-axis denoted by risk-free. The following that investor can split their portfolio allocation between risk-free and efficient without the loss of generality, and that becomes another dimension. So the risk-free, when we look at the risk-free and when we draw that, then we feel when we get a line that's tangent to market portfolio. So the observation leads to a tangent line and a market portfolio end, which is the most efficient point on the curve. The investor can now lever up, and they can take a loan and get this market portfolio and can move up then the efficient frontier. So the equation becomes all dependent on this market portfolio and taking risk and buying more of market portfolio rather than on going right. So the equation becomes like expected return of risk-free and plus expected return of market and different weights given to them. Here we see the market return is defined by beta, which is covariance upon a security and a market, or a portfolio upon market, upon standard deviation of the market, and we square that. So this is a natural interpretation of slope of a regress line. The beta can be described as a sensitivity measure of expected return to the variance in the market returns. So a more general case happens when we have a portfolio of n risky asset. So we know that we will have n into n minus 1 by 2 covariance terms. As the portfolio gets larger, the number of covariance terms grows with n, and the covariance terms are the only non-zero term remaining, and the weighted average is the residual risk defined as beta. So when we move ahead and we see that the last observation can help us identify zero risk portfolio, the returns on a risky asset will be uncorrelated with the market, when that is when they have beta of 0, when the variance of the asset is exactly offset by average asset return covariances with other asset returns. The zero beta asset return will then be riskless in the market portfolio, since it contributes nothing to the market return volatility. With the presence of risk-free lending and borrowing, an asset with zero beta must have risk-free asset. Thus, Sharpe-Littenger CAPM was defined as return by risk-free plus beta into return of market minus risk-free. So Fisher-Black version of CAPM removes the assumption of riskless borrowing and lending. However, in its place, Black inserts an equally unrealistic assumption by allowing unrestricted short sales. In either cases, both the CAPM imply that the market portfolio is mean very inefficient. The model differs, however, on the assumption of the zero beta assets. The black model is a more general, since it only predicts that zero beta portfolio must be less than the expected market return. When we look at the empirical test of CAPM, and the empirical test of CAPM can be grouped into early test of CAPM and more recent test of CAPM. In short, the early were supported by more general black version, but rejected the more restrictive sharp Latent model, and the subsequent empirical tests do not support either. So the earlier the test supported black but rejected sharp Lintner, and the more recent one is rejecting everything. So the early tests have three findings, and they are like expected asset returns and market beta are linearly related. Risk premium associated with beta is positive. The sharp Lintner version predicts that the annual return of a zero beta asset is equal to risk free, that is its uncorrelated market return. Further, the beta factor premium is equal to market risk premium. So the earliest empirical test examined the specific prediction outlined in number 3, that is sharp Lintner 1, and these empirical tests use both cross-sectional and time series data. The only cross-sectional test regressed a cross-sectional averaged or estimate of betas. Unfortunately, using beta to estimate expected returns is impressive. In addition, these models contain correlated errors from industry effects and other similar factors which push a downward bias on regression coefficient standard error. As a result, the next way of model tested portfolio betas rather than individual betas to return the effect of aforementioned measurement error. So recall the beta of portfolio is linearly related to individual asset beta. Hence, the inferences from portfolios should be same as those of individual assets. However, forming portfolios reduce statistical power of the test because the range of beta is significantly reduced. So finally, the researchers settled down on grouping portfolios sorted by beta in deciles from low beta to high beta. This methodology is standard when conducting empirical test. So the whole idea here is to understand that the way in which we calculate beta and expect that the returns are going to be based on this beta model is kind of shaky one, and that's part of early test and not the more recent test. So the pharma Macbeth model introduced time series method to reduce cross-sectional correlation error problem. This method estimated monthly parameters and examined their property over time. Since the parameter estimates are judged efficiently against themselves, the repeated sampling incorporated the effect of correlated errors. Along with portfolio sorting, pharma-backed method is used in current academic studies. Jensen pointed out the sharp Lintner version of CAPM also employs a time series regression. An empirical model was estimated on a monthly basis to show that the excess return on the asset equal to predicted return according to CAPM. This was foundation by Jensen's alpha as an intercept in the time series regression model. So which said that risk of a portfolio is not going to return just with the beta, but it will have an alpha which could be positive or negative. So the alpha is not zero. That's what Jensen did the research, and the empirical test using this approach strongly rejected the CAPM. Specifically, the estimated regression line is too flat, an intercept greater than RF, and a slope less than long-term US equity. And low beta stock exhibit returns over the predicted CAPM, while high beta stock return over. And this is the inverse beta strategy that, if you remember, we talk about in the index quant class. And what I told was that there is a strategy that says that CAPM is fraud, and everybody is believing CAPM, 99% of the industry. So actually buy the high beta stock and short the low beta stocks if CAPM is showing a particular direction, if everything is equal, and if their market cap volumes are equal, and then just take reverse bets on beta. So that was kind of quant strategy, and here we are talking about the same, which are the empirical result of Jensen's alpha, that low beta stocks exhibit returns above predicted CAPM, while high beta stocks exhibit returns below predicted CAPM. Further tests on the above framework incorporate additional independent variables which should not differ from zero. These variables included squared beta term residual variances, but do not invalidate the previous finding. And the CAPM appear linear, and the beta is the only source of risk. Ultimately, neither cross-sectional nor time series literally test the CAPM. And however, these empirical do show support for existing mean variance proxy portfolio lies in the efficient frontier. However, Roll discussed that exact market portfolio consists all of investable asset is not observable, which create a hypothesis test between CAPM market portfolio. So this was all about the historical. This is something that again comes into the index quant thing, and a screening technique that we again talked about in the last classes, that you screen and create deciles and then decide on which stock you're going to take. So the more recent test began in 1970, and these models included additional variables and they took things like earning to price, debt to equity, book to market value, and demonstrated explanatory power. The influence finding of pharma was the final nail in the coffin of the literal. If you remember, pharma-French model is again used in CFA level 2 exam, where it's used in equity, where most of other things explain what is explaining the return, not just CAPM. So that's again when we saw that, which is both the multi-factor model and the pharma-French model. So their empirical approach demonstrated the systematic influence of market within the cross section. This market is a turning point. A researcher acknowledged the series of weakness of CAPM and regularly estimated multi-factor model rather than single-factor CAPM. There remains the possibility that results are simply a byproduct of chance. However, similar circumstances uncover the same irregularities. So the whole idea is that after the CAPM, the French came, and he told that there are a lot of other things like earning to price, debt to equity, book value to market value that have explanatory power in the returns of a company. So the next challenge was to explain the discrepancy between CAPM predicts and actual empirical finding, and behavioralist view sorting firm by market scale variables such as book value of equity and sorting on investment tendencies. So specifically, high book B by M firms are viewed as poor performers. Financially repressive, price driven are too low. Upon recovery, the BM stocks may appear to be large. Low B by M firms, on the other hand, were viewed as growth firm, but high stock growth driven up by superior performance mutes further growth, which contributes to lower observe. Now this is something which I talked about in case of also the EV by EBITDA and all these terms, like when you look at a company which is having high price in the stock market, and you will see that the multiple is high, that means that they have given a higher price. That is because they are expected high growth. So growth is also coming into the picture. So B by M should be selected on the same growth tracks when you are picking something. Some economics view that the assumption of CAPM are too narrowly constrained relative to investor concern and investor opportunities. Not surprisingly, this limits the observed fit between model prediction and empirical results. For example, the assumption that investors only care about the mean variance of a single period is not likely accurate. Taken literally, this would preclude investment into other assets whose risk exposure may be different than purely variance and directly related to beta exposure. So a stricter assumption of CAPM and lack of empirical led researchers to go for better asset pricing model, and ultimately Merton developed a more general version of CAPM known as intertemporal CAPM model. The key extension is an investor can consider factors in their asset allocation decision other than the end of the period wealth. Thus, investor can explain in question how their wealth is affected by intertemporal state variance, further labor income consumption, future investment object. This observation implies that investor considers additional factors other than beta. Thus, investor must also incorporate covariances of each state variable with portfolio returns. In CAPM terminology, the investor will choose a portfolio that yields higher expected return for a given return variances and covariances with state variables. So the state variable seems like something like APT or multi-factor thing, and this is how it moved across. So in this period, Pharma French included two additional to CAPM, that is SMB and HML. SMB is the difference in return between diversified small and big stocks, and HML is the difference between high book value to market value and low book value to market value. Technically, these factors don't have theoretical support, nor they are considered state variables. However, indirectly they do capture the empirical irregularities of small firm. So this three-factor model has become standard in academic studies. Other research, however, identified moments of fourth factor. The moment variable would capture the difference between winning and losing portfolio over previous period. Since the moment factor is relatively short-lived, it is more important for implementation in studies manager. So that was all about the CAPM. Before we end, we'll look at roles critique. So essentially, strict interpretation of CAPM requires market follow that includes market weighted proportion of all. So Low-risk critics relies on the assumption that joint hypothesis of CAPM and market portfolio. Hence, any rejection of CAPM may imply an artifact of using an observable but incorrect market portfolio proxy. In extreme, any empirical test of CAPM is also a test of market portfolio. So, the lack of hospital market for precludes any testing of CAPM. Hence, CAPM was not truly tested and probably will never be. So, a lot of critique here of the CAPM, and we use market proxy problem, which is pointed by role critic, notes that actual market portfolio is unobservable. Therefore, an empirical test is a joint test of CAPM and the market portfolio. Thus, the CAPM simply be the form of using an incorrect market portfolio. So, CAPM has never been truly tested. So, this is again a thinking of how we took on CAPM. So, that was the story of CAPM for the FRM part 2. I hope you liked it, and see you in the next video.